Alrighty. So in today's video, I'm going to give you an inside look into my portfolio so you can take a look at some of the positions that I have and also how I trade some of the strategies that I've shared on my channel. Right. So hopefully this will give you some insight and idea as to how you too can design and construct your own portfolio. All right, so I have a number of portfolios to share with you, so let's dive right in. So the very first portfolio that I want to share with you is this portfolio over here. So this portfolio is with Interactive Brokers, and for this one I mainly only trade the wheel strategy, right? So as you can see down here, the stocks that I have here are mainly to trade the wheel strategy, and except maybe for one that I just realized, right? So as you can see down here, there's this stock ticker down here, it's D05. That is not part of the US market, right? So if you're wondering what kind of stock is that, is this good for wheel strategy? How come I can't find that in the US stock market on my platform? Well, that's because it's not a US stock, right? And this stock down here is with my local market. And the only reason it's here is because I wanted to test Interactive Brokers to compare, how it is to my local bank platform. So generally I also have a portfolio full of dividend companies, so I would invest in all these companies to receive dividends. And another thing, just to sidetrack a little bit, is that you also want to consider maybe also a portfolio full of dividend stocks, right? So these dividend stocks can give you dividend over time as a form of income as well. So I believe in multiple sources of income. So in my investment portfolio, dividend is one of them. I have other types of investment income as well that has nothing to do with options, right? So this is something that you want to consider for yourself as well. All right, so let's get back to this portfolio. So this portfolio is mainly on the wheel strategy, but for the way that I trade the wheel strategy is slightly different from other people. So the way that I trade the wheel strategy comes to two types inside this portfolio. So I have the income grid wheel strategy, which I already shared also in my channel, so I won't go too detailed inside here. And the other one is what I call the enhanced wheel strategy. Okay, so let me just get into it very quickly so you have a context as to how I trade them inside this portfolio. So basically the traditional way how people trade the wheel strategy is something like this, right? So imagine this is the price. So let's say, for example, if the market is somewhere here and somebody wants to get into the wheel strategy, you first start off with the cash secured put, right? So the cash secured put, when you sell it, you're going to get a premium for it, right? So two things going to happen. If it expires worthless, that means the market stays above this cash secured put by expiration, then you're just going to receive the premium, right? But if it goes all the way down, which is also what you don't mind, which is what you want as well, you're going to get assigned, right, at expiration if it stays below this cash secured put. So once you get assigned, what's going to happen is that you're going to get 100 shares, right, per cash secured put that you have on. Now the next step is that you want to sell what's called a covered call. So when you sell a covered call, basically it's a way for you to also get some income because you're going to receive premium for it. And then if the market goes back up, then you're going to get called away on your shares and you do the wheel strategy all over again, right? So basically the traditional wheel strategy, how most people do it, is that they only have two income sources, right? All they want to do is just keep selling the cash secured put and a covered call just to keep getting the income. But for myself, the way that I trade it is slightly different, right? So first of all, I have the income grid wheel strategy. So the income grid wheel strategy basically is, instead of having one level of cash secured put, whereby, if the market goes all the way down, you can get caught in there, and then basically you'll be trapped in the position for a long time, like many people have in 2022 or when the market crashes, right? So the way to actually, sort of like reduce the chances of this happening is to have multiple cash secured puts. Now, one thing I want to really point out down here is that the risk is actually no different from the ordinary way where you do the wheel strategy. The only difference is that you stagger out your position. So let's say, for example, if you're trading the normal wheel strategy, let's say, for example, you can sell 3 cash secured put. Right, that is your position size. So if you can sell 3 cash secured put, instead of putting it all on just one level, what you want to do is you actually split them up into 3 different levels. So this way, at least if the market comes down, you still can continue selling this premium, right, the cash secured put. At the same time, if you do get filled in a sense whereby you're assigned on all the cash secured put, at least your average price right now will be slightly lower than if you all had it at one place, right? This way it's easier for the stock to break even or even be in a profit as the market comes up. So on the way down, you stagger your entries, and then on the way up, same thing as well. You stagger your covered calls. So you do not sell your covered calls all at one place, right? You stagger it as it goes up. So this way, you can keep selling the cash secured put as well as the covered call. So this is the main gist of the income grid wheel strategy. Now, the other thing that I do that most people I find do not actually do in their wheel strategy is to actually get the capital gains part of the wheel strategy. So for example, let me just remove this right now. There are two ways most people are actually getting an income from this wheel strategy. So number one, sell the cash secured put. So when you do this, you get some profit. Now number two, you sell the covered call. When you sell the covered call, you're also going to get some premium in the form of income. But number three is what's generally missing from most people, and that is the capital gain. Right? Capital gain for me is quite important for the account as well, because this is where you're going to get growth, right? Growth whereby if the stock actually goes up, you actually profit from the gain of the stock as well, right? So if the market comes down below this price down here, your cash secured put, you're going to get 100 shares. So once you get 100 shares, you don't immediately sell the covered call, right? It's not necessary for you to just keep selling the covered call the moment you get filled, right? You could actually wait for the market to go back up before you sell the covered call. So this way, right, you actually earn the difference in terms of the profit of the shares, right? So if you get assigned at this level here, and then you have your shares called away here, you have an additional profit of the capital gains. So when you do it this way, your portfolio can really grow as well, instead of just relying on these two income. Because many times you will find that if you get in at the wrong price, which is what a lot of people actually experience, then it's very hard to keep getting the income right now, because you're stuck with the shares and it's way below your current entry price. Even covered calls, it's going to be difficult for you to get any premium if you want to sell it above or at where your cash secured put is. Now, the other way that I trade the wheel strategy is what I call the enhanced wheel strategy. Right, so basically the way that I trade with this enhanced wheel strategy is, instead of using the traditional cash secured put, what we're going to do instead is we're going to enter into the position with what's called a put ratio spread. So if you've been watching my channel for quite some time, then you know that I like the put ratio spread quite a bit, because I use them quite often to enter into my trades. So the put ratio spread in this case basically is using the cash secured put, the premium that you receive from that, to finance the purchase of a put debit spread. Right, so when you have the put debit spread, if the market comes down, what you're going to do is you sell off the put debit spread for a profit, then you're left with the cash secured put, right? Then in this way, you just manage it as you would with the traditional wheel strategy. So once you get assigned, let's say for example, you get into the 100 shares, now on the way up, instead of selling the covered call, what you're going to do is you're going to sell the call ratio spread, right? So the call ratio spread is basically using a covered call and then using the premium from that to finance a call debit spread, right? So this way, if the market goes up and it goes past this call ratio spread, what you're going to do is that you can sell off the call debit spread for a profit, and then you're left with the covered call. So that's basically the two different ways that I trade the wheel strategy. Now, the next very important thing I want to touch about whenever you want to trade the wheel strategy, for me personally, is that you need to choose the right stock, right? The stock selection is very important, because if you want to have the capital gains on the stock that you choose needs to have a chance to eventually go up over time, right? That is why, I tend to want to choose fundamentally strong stocks, right? Fundamentally strong stocks whereby, their income statement is strong. Generally, I like to see that, the companies are profitable over the past few years, right? So if the company is not profitable at all, then chances are that it can also reflect in the stock price. You'll notice that many times, a lot of the companies that are not making money, they're not profitable, the stock actually don't go up, right? They will just go sideways, up and down, and basically it's going nowhere for most of the time. So that is why if you also want to get the capital gains, then the stock selection part is very important, right? Don't just go for stocks that are very high volatility, because a lot of people like to go for high volatility thinking that, hey, I get a lot of premium just from selling the cash account put and a covered call. Yes, you get a lot of premium for that, but the problem is that if the stock never goes up, and the wheel strategy is generally a bullish strategy where you want it to go up, then you can get into trouble, right? Some people get into the wheel strategy, they sell in terms of the premium, they get a lot, but the stock keeps crashing and it never comes back up. And in the end, they actually lose money. So that is why stock selection is important. So very important. Do not look at my list down here, the stocks that I trade, and say that, hey, I'm going to follow exactly as Davis because you see, he is making money on his stocks, right? Except maybe for the last one, right? At least not yet, right? So don't do that, right? Because firstly, it may be a fundamentally good stock, but it may not suit you, right? Because you may not think that it's fundamentally good. You might not like it, right? For example, some people don't like Adobe, some people don't like Google or Meta, and they will say these are crap stocks, right? So yes, perfectly fine. If you think it's not suitable for you, you don't want to get into it, don't do that, right? You just want to do your own due diligence. At least the companies you go for, the very least is that they are making money. They are a profitable company, because every stock that you are trading here is a company, right? So you just need to understand that. Now, the next thing is that it may be a good stock, a good company, but you may get in at the wrong price, right? So again, do your due diligence. Don't just jump straight in just because Davis traded and you want to trade it. Now, the next thing I want you to take a look at is the P&L down here. So for the most part, when I trade the wheel strategy, I kind of get out of the shares, right? Basically, the wheel strategy, you get into the shares and then you want to sell the covered call as it goes up, right? As you can see, the market has been going up recently. So I've been trying to sell quite a number of covered calls. So for the most part is that you're getting in and getting out of the stock. But one stock down here, I want you to take a look at is this one down here, where you notice the P&L is far greater than the others, right? As you can see, it's over $145,000 as of this point, and this is with Google. So the reason why this is much more is because I actually hold some of the stocks, the shares, where I don't get out of it, right? So if I get assigned on the shares, I actually only get out about a part of it, right? A portion of it, I would try and get out with the covered calls, because right now the market is going up. And as you can see, it's kind of a little bit overbought. So I'm trying to get out of some of them. But at the same time, what if I'm wrong, right? What if the market continues to go up? Because I still believe strongly in the company. So this is one thing, I have conviction in the company. So I think it can go higher. It's just that maybe right now it may pull back. So that is why I'm only using a part of the positions which I have to sell the covered call. So how do you exactly find out, what are the stocks to put inside here? So my process is actually nothing special, right? It's like how anybody would find out about the stock. So basically, I would do research on the news, right? Read the news and see what some people are actually investing in, what they're trading. I'll also take a look at some YouTube videos. And then I will do my own due diligence, right? I won't say, hey, I heard this person is actually doing it and I'm going to get into it, right? I won't do that, right? I will do my own research. And one of the ways that I like to do my research is using finance.google.com. So let's get into finance.google.com and I'll show you a little bit of what I look at inside. So this is Google Finance. So one of the things that I really like to look at with Google Finance is the income statement of the companies that I'm planning to do the wheel strategies on. So one of the companies, as you know, is Google. So what I'll do is just let's take a look at Google, right? So as you can see down here, there are a number of information that you can take a look at. The one that I like to see is this one down here. So as you can see down here, this is the income statement of Google, right? So you can see based on quarterly is doing pretty well, and annual as well, right? You can see for the past 5 years, revenue is increasing and it's generally still profitable over the past 5 years, which is very good, right? You can go even deeper into seeing all these things as well. You can go into their balance sheet. Let me just go down here, balance sheet. You can see the balance sheet and as well the cash flows. So this will give you, just an insight as to what this company really is about. So I do suggest that if you want to trade the wheel strategy, you do want to look into the company to find out what actually you're trading, as opposed to, some of the people out there, when they trade the wheel strategy, they're just mainly looking for high IV, right? Because they want to have the juicy premiums, they want to sell it. I feel that that is doing a little bit of a disservice to yourself if you're just doing the IV, because when you get into the wheel strategy, it's a pretty capital intensive strategy because you need to actually get into long stock. So if you're going to get into the shares of the company, you better need to know if the company is actually going to have a chance for it to go up over the long term, right? So at least one of the ways is to see if the company is profitable, like I mentioned many times. So most of the stocks that I have in my portfolio tend to have this trait whereby they have been profitable over the past few years, with the exception of just one stock, right? And that stock is Palantir. So let us just get into Palantir down here. So Palantir has only recently become profitable, right? They weren't profitable many years ago. It's just only recently. So as you can see down here, the income statement, the quarterly income statement is actually pretty okay, right? They just recently turned a profit. For the past 5 quarters, they have been increasing their revenue and the profit, which is good. But if you take a look at the annual, you can see that actually they lost money before 2023 and only turned a profit in 2023. So that is why, for the wheel strategy for the Palantir, actually do not put in as much as the other underlying. But one thing I will never put my money into to do the wheel strategy is stocks like GME. And why is that so? Because GME, if you were to go to the financials over here, you can see that it has not made any money at all, right? You can see that it's been losing money for many years. Now, 2024 has not ended, so we have no idea what it is, but I'm not going to bet on the fact that, hey, it's going to be profitable. That's why I'm going to do the wheel strategy, right? For GME, this kind of stock is actually a very highly manipulated stock, right? Highly manipulated. What I mean is that just one person can basically shift the entire sentiment of the stock. For example, Roaring Kitty, right? As you can see down here, if he tweets about GME, then the stock is going to shoot up. But if he stops talking about it, the stock is suddenly just going to die. So I don't really like this kind of stock. And this is something that I'll caution you as well if you're planning to do the wheel strategy. So I'm now in the account management page of my broker. As you can see, this interactive brokers, you can see my name at the top right down here. So you can see the net liquidity currently is slightly above $500,000, right? As you can see down here, for this portfolio is $559,000 as of this recording. And for this past 1 month, right, as you can see down here, this is of the past 1 month, it has gained roughly about $53,000, which is not so bad. And also because the market has been going up. So this portfolio gains in 2 ways, right? You have the income from consistently selling the cash account put as well as the cover call, and as well as the capital gains from the stock, right? So as you can see, the start of the portfolio, or rather the month, is about 506,000, and towards the end, about now, it's at $559,000. So far this portfolio is doing decently well. By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month, trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. Okay, so the next portfolio that I want to share with you is with Thinkorswim, right? So as you can see down here, I'm using the Thinkorswim web platform. So now it's under Charles Schwab. So you will have to log into your Charles Schwab to be able to access the Thinkorswim platform. So basically for this portfolio, I have a mixture of strategies, which is different from the very first portfolio I shared with you. So the first portfolio is mainly all wheel strategy. Now for this portfolio, I have a few strategies, and the first one is also the wheel strategy, right? So I also trade the wheel strategy in this portfolio. And then the second one is Leaps, right? So Leaps, I already created a video on it. So if you're curious on how I trade Leaps, you can just go ahead to find the video on my channel. And then the third one would be the shorter term trades, which is the put ratio spread. I also have the put broken wing butterfly, and then also the wide put ratio spread, and also the put condor, right? So these are more shorter term trades down here at the bottom. Now for the wheel strategy, as you know, there are two types, right? It's you get income as well as you get growth, right, from the capital gains of the stock. Now for leaps, it's mainly only growth, right? Because for the way that I trade leaps is that you're actually buying the leaps, right? So this will be a debit. So the only way that you can profit from it is if the market goes in the direction of your leaps. And then finally, for this third one down here, all these strategies down here, they are all based on income, right? So as you can see, this is again, this portfolio is a mixture of income as well as growth. Now this time you might be looking at this portfolio and you're wondering, Davis, why is your wheel strategy over here, right? Why didn't you put it in the very first portfolio? And that is a good question. And the reason why I'm actually doing it this way is because I initially all traded in just one account, right? It's actually just this account that I all trade. So all the strategies that I trade, including the third portfolio, which I'm going to share with you later on, all the strategies I just trade here, and the account size was over $1 million. So at that point, it was with TD Ameritrade, right? So TD Ameritrade had a presence in my country, so I was comfortable with, trading the large account there. But when Schwab actually bought over TD Ameritrade, they basically kind of removed the presence in my country, right? So now it's pretty much all in the US side. So I spoke to a number of people, and apparently the sentiment of Schwab was not that positive compared to TD Ameritrade. So that is why I'm trying to play it safe. So what I've done is that I've just diversified my portfolio into 3 different accounts, right? Because the SIPC, as I understand, only insures up to $500,000 of your account if the brokerage fail. Now that's not to say that Schwab will fail, right? I still believe Schwab is a strong company, but hey, you never know, right? So in the event if the company does fail, at least I've been insured up to $500,000. So that is why I separate my account. I try to split them equally among the 3 accounts. So this way, at least if one fail, right, I still have the SIPC covering me for one of them, and then I still can trade on the other 2 platforms. So this is just a form of diversification, just in case if the broker fail, like back then, right? MF Global was a big issue back then, and then also when a lot of these investment banks fail, right? So you never know what's going to happen. So if you do not have more than $500,000, hey, don't do this, right? There's no problem just trading just one brokerage. But if you have more than $500,000, then you can consider what I'm doing down here. All right, so let's get back to this portfolio down here. So as you can see, this portfolio over here has 3 different kinds of types of strategies, so to speak. So for the most part, you can see that the kind of underlyings that I choose tend to be the positive drift one, whereby the market will go up over time, right? So as the market goes up over time, the strategies that will benefit from this will be the wheel as well as the leaps. But what if the market starts to come down momentarily, right? Maybe the market goes sideways, or even there's a very big correction, the market comes down. So this is where the shorter term trades will come in. So these are the trades where I get in and then get out. So that's why you can see over here in the P&L open is that certain P&L do not have a very big one compared to the rest, right? Because they are more shorter term, right? I trade them and then I get out. But that is not to say they're not as profitable as the other underlyings that I trade. No, they are very profitable as well. So right now I'm in my account management page inside Charles Schwab. As you can see down here, it recently moved from TD Ameritrade to Charles Schwab. So I was one of the clients where I started off with TD Ameritrade, and then Charles Schwab moved my account over to them. So as you can see over here, this account is doing not so bad as well, right? As you can see down here, for the past 1 month down here, you can see that the total value right now is over $500,000 as well, right? So it's about $562,000, and you can see for the 1 month change, this last 1 month it made about $61,000. So not too bad, right? The previous portfolio did about 50 something thousand dollars, and you can see over here, let me just quickly get my pointer. So as you can see, at the start of month is roughly just over 500,000, and towards the end, as of this recording, right, slightly above $550,000. So this portfolio also is doing not so bad. So the third and final portfolio that I want to share with you is my Tasty Trade portfolio. So as you can see in this portfolio, there are a few things going on, right? So there are a few components. So the very first component of this portfolio, as you can see right at the top, are the T-bills, right? So in this portfolio, I have some T-bills. And in my humble opinion, I think that the T-bills, at least as of this point, is a pretty good way for you to get some risk-free profits, right? Because it's guaranteed by the US government if you hold all the way to maturity, and provided that the US government doesn't fail, right? Of course, if the US government fail, then I think there's going to be much more problems in the world, right, if they default on the bonds. But for the most part, I think it's pretty safe, right? So if you're not familiar with what the T-bills are, basically, you always buy at a discounted value, right? So there's the discounted value, and then there's the face value upon maturity. So as you can see on the right-hand side down here, this is the average open price. So on Tasty Trade, it shows a 960. So the price which I bought it at is $960. This is not that I've lost $960. It's not that, right? So this P&L open, right? You see at the top, it doesn't reflect this T-bills, right? So T-bills, basically when you buy it, it's as of a discounted value. And then upon maturity, if you hold all the way to the maturity, basically the maturity you can see on the T-bills down here is towards the end of October, which is not too far from now. The face value then becomes $1,000, right? So you bought it at $960. It is guaranteed to become $1,000 upon maturity, right? That is if you hold all the way to maturity. But if you were to decide to get out of it halfway, then it's possible that you could lose money, right? It depends on what it's trading for at the point of time when you want to close it. So as you can see down here, this is the current close price of the T-bills that I bought, and it's at 982. So at the moment right now, it's in a profit, of course. But there are times whereby, you know, especially when you first buy it, it's possible that it could be in a loss, right? The price could have gone lower. So that is why if you want to put, you know, some cash into the T-bills, it's best that you hold all the way to maturity rather than you trade it, right? So I definitely do not suggest to trade T-bills in this way, right? So for this one, you can see that I have purchased roughly 210 T-bills. So that means to say upon maturity, I'll get 210 times $1,000. That's about $210,000, right? So this is the roughly this is also the capital that I put up, right? So it's a very good way for you to diversify your portfolio as well, because, you know, if you do have some spare cash lying around, you definitely can put into some T-bills instead of putting all into options, right? So I again believe in, you know, diversifying a little bit here and there into slightly different product types. So for example, the profits that I get from this T-bills down here, I can actually use to boost whatever profits that I made in my portfolio, right? If I trade the options, I made some profits, this will be added on top of it. And if you're not profitable when you're trading options, hopefully not, right? Then at least the kind of profits you get from the T-bills can be used to cushion or offset some of the losses that you have. So this is the first component of this portfolio. Now, the second component of this portfolio is where I buy some shares, right? I don't buy too many, but basically, you know, I like to punt on certain underlyings, just a little bit to buy some shares. You definitely don't have to, but I do have some inside this portfolio as well, because some of the underlyings actually do not have options, right? Like for example, IBIT, right? IBIT, if you're not familiar with this is basically the Bitcoin ETF. So I do want to partake into it. So there's no options on it right now. So for this IBIT, I just buy some shares here and there just for speculation purposes. Now, the third and final component of this portfolio are the options, right? So basically options are the main gist of this portfolio, and the strategies that I trade down here are mainly the income strategies, right? So income strategies are basically more shorter term strategies as compared to maybe the wheel strategy or the lips, because those are slightly more longer or rather mid-term strategies where you hold for a slightly longer time. But whereas for this portfolio, I mainly trade the income strategies where you get in and out in a relatively short time. So let me get into the exact strategies that I trade for this portfolio. So the very first strategy that I trade is the credit spreads, Right, so the credit spreads, I've already created many videos on this inside my channel. So definitely go into my channel and look at the credit spreads. I share with you exactly, how to trade them. And credit spreads are a very beginner-friendly strategy because there are only 2 legs into the strategy as opposed to some of the other strategies. So credit spreads, definitely you can look into them if you're interested. Now, the second strategy that I have is what's called the Jade Lizard, right? So the Jade Lizard is basically a short put and a call credit spread. So it's an undefined risk strategy. Now, if you don't have a big enough account size to put on the Jade Lizard, then you can go for what's called the Jade Iron Condor. Right, so the Jade Iron Condor is a name that I came up with. I coined this mainly because I took after the Jade Lizard, which is named by the Tasty Trade folks, right? So the Jade Iron Condor is basically the defined risk version. So if you have a small account, you can definitely trade the Jade Iron Condor. So the Jade Iron Condor and the Jade Lizard is a construct that has no risk to the upside, right? So if you're afraid, the underlying that you're trading is going to keep going up and up and up, then you can definitely trade the Jade Lizard or the Jade Iron Condor. Now, the third strategy that I trade over here is what's called the Strangle. Right, so I have quite a number of videos on the Strangle as well. So Strangle, again, it's an undefined risk strategy. Very good if the market goes sideways, right? The market goes sideways, the Strangle is where it really shines. And if you don't have the capital or the buying power to put on a Strangle on the underlying, then you can go for the defined risk version, which is the Iron Condor, right? So Iron Condor, again, I have a number of videos that I've shared on my channel as well. And I also have created a number of trade management videos on it as well. So definitely go and check that out if you haven't already watched it. Now, the fourth strategy that I trade is the put ratio spread. So again, you have seen this in portfolio number 2. I trade the put ratio spread there. I also trade the put ratio spread here, and it's an undefined risk strategy. So if you do not have the capital again to put on the put ratio spread, you can go for the put broken wing butterfly, right? So all these strategies you can certainly trade if you don't have a large account, right? If you have a small account, maybe under 100,000 or maybe even under $50,000, you can definitely trade some of the strategies that I've shared here. Now, the last and final strategy that I trade inside this portfolio is what's called the wide put ratio spread. And basically, it's just a variation of the put ratio spread. I've also created some videos on that. You can go and check that out. And let's say, for example, you do not have the capital to put on this wide put ratio spread, which is an undefined risk strategy. You can go for the defined risk strategy, which is what's called the put condor. And again, I've created a number of videos on that, so definitely go and check that out. So as you can see, all these strategies are doing pretty well for me, right? So you can definitely use these strategies as well, but of course, you need to have proper risk management, right? One thing I always emphasize is do proper risk management whenever you put into a trade, because although these are primarily high probability strategies, that doesn't mean that you will have a loss, right? There will definitely be a loss, right? For example, if an 80% win rate strategy, it just means that 20% of the time there will be losses, and you just make sure that 20% of the loss does not wipe out all the gains that you have. So risk management is very paramount whenever you're trading options. All right, so these are my portfolios. Hopefully this has given you some insight and also idea as to how you too can design and construct your portfolio. And let me know in the comments below, out of these 3 portfolios, which is the one that you like the most. By the way, if you like this video, then you're absolutely going to love this next video which I have for you. So go ahead and watch that video right now. Also, if you haven't already gotten your free copy of the Options Income Blueprint, you can do so just by clicking this link down here on your screen, and you'll be able to get it for free. Alright, I will see you in the next video.